This is Trepp Wire Week in Review for week ending December 12th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, the FDA is deciding approval for the Pfizer vaccine today. This as the U.S. breaks records daily now on hospitalizations and deaths. Looking at economic news, consumer prices rose in November. Initial jobless claims surged to the highest level in 3 months, and early December saw 1/4 of apartment households failing to pay rent. Meanwhile, two market debuts, DoorDash and Airbnb, benefit from pivots in consumer behavior in retail and lodging. Manus, the sense is that, like several months ago, we're at an inflection point with the next few weeks dependent on how fast a vaccine can be approved and distributed.
Well, it was an interesting week, wasn't it? It's been an interesting month in that I feel like several former crises are coming back to haunt us all at once, right? Crisis number one is COVID-19, right? We saw the depths of this in April, May, and June. Then we seem to have a leveling off both of cases as well as delinquency numbers, special servicing numbers, et cetera. Now it feels like with store closings and with restaurants closing and more shutdowns, we're back to that April, May, June period. And what makes this so much worse right now is that in the spring, we were dealing with this really on a regional basis. This was a Northeast thing, and people were concerned in other places, but they hadn't been hammered with infections and hospitalizations. So I felt like the closings in some of these other areas were loose, right? That people were still going out and they were still getting their food, even if it was pickup and so forth. Now it seems like more of a nationwide shutdown. So it wouldn't surprise me at all if we see upticks in delinquencies, distress, companies, reducing footprints where their leases are coming due, more corporate bankruptcies on the retail side. So that's one angle, right? Angle number two is with the DoorDash, with the Airbnb, this felt a lot like the late 90s crisis, right? Where IPOs were coming out, things were blowing out the door, doubling in one day. And to be sure, DoorDash and Airbnb have revenue, and Barron's wrote a really glowing, I think it was Andrew Barry, piece this week about the prospects of Airbnb. But it does have that frothiness feel of 1999. So it's two things kind of coming together at once. And at the same time, today's CPI number, there's that little whiff of inflation out there that has everybody just a little bit concerned, which would kind of bring back another crisis from the 80s. So I tend to be a very glass half full right now. And I do think we come out of this in February, March, and April strong, stronger than, or almost as strong as we were pre-COVID. But these next 2 or 3 months could be awfully rocky.
My feeling, well, first of all, maybe they mispriced that Airbnb IPO a little bit. I think at 110% gain on day one, although I know that that's part of the allure. That's part of the whole thing. They like to have that first day pop. I'm looking at the Wall Street Journal coverage of it, and through the first 3 quarters of 2020, Airbnb has lost $700 million. That's a little bit more than double what they lost in the first 3 quarters of last year. Now, they apparently reacted very well to this whole COVID crisis. They streamlined their business. They cut kind of non-core operations, and they really kind of focused very hard. And then I think we saw, I think we called it. I'm pretty sure it was us on this podcast in March or April when we said, no one's going to be flying anywhere, but everyone's going to be going to the Jersey Shore and staying at an Airbnb, right? Or everyone's going to be going to, the Gulf Coast or wherever your driveway destination is. So they did benefit from that. I was looking at a chart. I can't find it now, but it was a chart of Airbnb bookings, year over year changes, plotted against Marriott and Hilton and all the other hotel chains. And Airbnb fell with the hotel chains this in the same direction, the same magnitude, but the hotel chains are still down where they were, or maybe they've come back a little bit, but they're still well into negative territory, where Airbnb actually came up back into positive territory during the crisis. So, and then DoorDash, I don't really get it. I mean, what's the difference between them and Grubhub and Seamless and any one of these other companies? So I don't know how you value a company like that in many, many, many billions of dollars when like anybody that can write any decent software can probably recreate it. I know they have the network and everything else, but it seems recreatable.
My wife says it's all about the map, that on DoorDash, you can see the map and you can see where your driver is. And, if you have enough time to get in the shower, or run to the post office before he's going to show up at the door, and Grubhub doesn't. And she said that that's the differentiator.
That was like Uber's differentiator. Like I can wait 15 minutes for a car as long as I know where that car is and that it's on its way. Right.
Right. I mean, the bull case for Airbnb is, the guy from PwC in the Brooks Brothers suit, he's not staying at an Airbnb, right? He's staying at a Marriott or Hilton. But that's the thing we said would come back last, right? That corporate travel. The first thing to come back is this pent up vacation travel, which should go hand in hand with a nice recovery of bookings for Airbnb. That being said, the explosive one day upticks just, it gives me that queasy feeling that I felt in 1999 when my buddies started buying Fog Dog.
Or pets.com. I might have to dabble in some Airbnb put options tonight, but I'm not an investment advisor, so don't listen to me.
And what happens to DoorDash after the pandemic and everyone resumes a little bit more normal life?
Well, there you go. That's it, right? I mean, everyone, all of us dang millennials have been lazy bums who like to just open up our phone and get our food delivered to us for a long time. So I think that'll continue. But I mean, eventually we grow up. And like, I don't order food nearly as much as I used to at this point. And I think that will continue to happen.
It does feel like we're in this Neanderthal period right now, changing topics modestly in that,
is this the shower issue?
No, it just, with the days being shorter and it getting, sunset today was at 4:20 in New York, you feel like you're living in a cave. Right. And, my temptation is to get out my chalk and start, drawing stick figures on the wall so that when people find me, 70 years from now, they'll say, oh, here's where a financial analyst lived. And
Manus was here.
Yeah. I mean, it just does feel like you're living in a cave.
I go outside in the morning to put my son in the car for him to go to daycare. And then I come back inside. And the next thing I know, I've been sitting at this desk looking out the window and it's dark and I'm recording a podcast and I don't know what's happened in the last 9 months in my whole life.
You got to get the chalk, man. I got some buffalo on the wall now and I got, a spear and,
We can put some of these podcasts in a time capsule. We'll let you know what happened. So this week we released our special servicing report, which provided details behind the modest reduction in the overall November rate. Joe, it's usually something we put out that follows on the delinquency report.
Yeah, so this is something we came out with a few years back when the delinquency rate was extremely low and it was pretty steady. So there weren't many kind of breaking items within the delinquency report, but there were interesting movements up and down in the special servicing rate. And we'd always like to kind of highlight particular loans, especially if they're large ones that move in or out of special servicing. So last month, the special servicing rate came in at 10.16. This is November. We'll have numbers for December in the next week or so. And that's down just a modest 12 basis points from 10.28% in October. The usual suspects, retail and lodging. Lodging was up about 11 basis points to 25.56%, which is a heck of a number, more than a quarter of the universe. And actually, retail was down slightly, about 53 basis points down to 17.47%. The other major food groups Office was down a few basis points, multifamily up a few basis points, and industrial up a few basis points. So if you look at the chart, just go to Trepp.com and look at our research tab. You can pull this up. The chart was a huge mountain back in 2009, and it took until about 2012 to really start seeing a downtick in this. And it took from 2012 to 2016 to really get back to some sort of normal level of 5 or 6% special servicing. And now we see this again, this huge uptick starting in March. So it'd be interesting to see if the V-shaped recovery, this is like an upside down V, right, on this chart. At least the first couple months post the big uptick are pretty sharply downward. But now we've kind of hit this plateau. So we'll see if the plateau stays flat for a while.
I think the next move is up. And I think of it for two reasons. Number one is these loans went into special servicing. The borrowers got relief. The loan was sent back to master, and it resides there while reserves are tapped, forbearance of sorts, relief is granted, and so forth. But now with the new lockdowns, I think a lot of these loans go back to special servicing, pushing that rate back up again. And then I think you have new entrants that have been fighting the good fight for a long time in secondary and tertiary markets that have been impacted but not clobbered, starting to get clobbered now, right? In places where you're seeing hospitalizations grow, cases grow, et cetera. That bounce that they were expected from holiday travel or bowl game travel or vacation travel, it doesn't come. And while there's light at the end of the tunnel come April or May, they need relief now, and those loans start heading to special servicing. So the next move for retail and hotel, in my eyes, is up.
Well, it used to be, remember, we actually split it out by pre-crisis vintage and post-crisis vintage. And it used to be, and that's like basically 2007, 2008, anything originated or issued then or before was the 1.0, and everything originated after was 2.0 plus. And it used to be that the 1.0 stuff had very, very high special servicing and delinquency rates. And that's because most of the stuff that's still outstanding should have paid off already. So there's a reason that they're still out there. But now it's kind of equal opportunity. So it didn't matter when you originated. It didn't matter what your underwriting was, COVID, equal opportunity destroyer type of thing.
Adverse selection, that's the term.
Adverse selection, that's right.
The good loans pay off, get to fees, get refinanced, pay off at their balloon date, and the bad ones linger around.
Well, you said light at the end of the tunnel, Manus. I'll take a quick detour. I did see a few NHL insiders on Twitter reporting that there would be a 56-game hockey season this year starting on January 13th. So in that case, I'm going to rejigger my delinquency rate projections even lower, because if the NHL comes back, then all will be well with the world.
Wow. He's optimistic.
What do we have on this anyway? Is it dinner at Sparks or something? Is there a Sparks still?
What, on the projections?
Yeah.
I think he wants a bet.
I don't know. Well, CMA doesn't ask me for projections, so I can't really stack up against you and your many, many years of knowledge and experience. I just have youthful optimism.
Exuberance.
That's right. Maybe over exuberance.
My only really black mark is that I've been picking the Giants to win the Super Bowl every year since 1972. So I've been right a couple times, but I can't get out of that habit.
Keegan is scowling over there.
And he's going to break the habit this year. This week, we also released a report in conjunction with CompStack looking at retail, which was a story that was picked up by MarketWatch, and they cleverly titled it "Ho Ho, Oh No."
Yeah, so we've mentioned it a few times on the podcast. We've been doing some partnership work with CompStack, both on the product side and on the research side. So this one this research report specifically took a look at Manhattan retail. Something that historically you didn't really have to worry too much about. I mean, there were some worries because rents were so dang high. Remember the rent is too damn high guy? That wasn't about retail, but it was true about a lot of the urban thoroughfares. But just a couple of data points here. looking at Manhattan retail specifically, special servicing rates near 18%, delinquency rates near 16%, almost 5 billion, a little under 5 billion in total outstanding. So, that's a pretty big chunk of the retail market in CMBS generally. Occupancy has been trending downwards, and that's data from CompStack. We were, near 98, 99% occupancy pre-pandemic, and now this is more kind of in the 94 range. So still a nice number. I mean, somewhere else you might say 93, 94% is good occupancy. And then we've done this this educational segment about appraisal reduction amounts, but we have a chart here on appraisal reduction amounts on Manhattan retail, and you can see it went from about 50 million outstanding ARAs all the way up to nearly 300 million, and that's just in October and November. So that's probably one or two large loans that have taken big ARAs, but you guys should take a look. I mean, there's also a couple of good kind of snapshots of the integration between Trepp and CompStack on there, kind of looking at comparables, both on the lease side and on the kind of financial and loan side.
There were a couple of interesting stories about New York retail this week that we covered in Trepp Wire. Both were very unique kind of stories. The first one was from the New York Business Journal. Target signed on for 27,000 square feet at 600 Broadway in Manhattan's Soho neighborhood. So that would be down by NYU. The property backs a $111 million CMBS loan that's split across 3 or 4 different CMBS deals. The interesting thing about this was the entire property takes up about 75,000 square feet. It's at the corner of Broadway and West Houston Street, like I said, down by NYU. The property was entirely vacant. Abercrombie and Fitch had been in there for a while. They had their Hollister flagship store there. There was a gym there that was leaving. So it was completely vacant. So that was one noteworthy part of the story. But the other was that in 2019, The Real Deal had pointed out that New York City Department of City Planning was targeting that particular neighborhood for violations of a law which said you can't have street level retail that exceeds 10,000 square feet. Abercrombie and Fitch had violated that. The owners of the building, I guess you could say, allowed them to violate that. So there was a big legal contention going on there. Eventually the building became vacant. In this environment, you couldn't be too sure about what was going to happen. And then all of a sudden you read the headline this week from the New York Business Journal that here comes Target with 27,000 square feet ready to jump in. So all of a sudden we now see this property going to be, a third full very quickly, which is great news. We see another New York retail lease coming on the heels of the 2 Home Depots that we talked about in recent weeks. And apparently the New York City Department of Planning no longer cares about the 10,000 square foot rule because Target's allowed to take 27,000 square feet here. So this is a nice turn of events for investors in those 2016 CMBS deals and that $111 million loan we were talking about. The other loan that was really of interest was 164 Fifth Avenue, which was owned by Thor Equities. I'm not sure if we've talked about this particular loan before, but we had written about it in October. There's a $22.75 million loan. The collateral is one parcel of street level retail. There's one tenant, and it's not a gym. It's like a yoga place, stretching that whole thing, touching your toes, lotus position. And
when was the last time you touched your toes?
Probably, JV
presidential
basketball.
Fitness test in 6th grade.
Yeah, probably JV basketball out in Eastern Long Island. So this is 164 Fifth Avenue. The borrower had approached the special servicer and looking to pay off the loan. They were looking to pay only a 10% yield maintenance charge on the loan in return for paying it off. Now, the yield maintenance charge on the loan, given prevailing rates right now, should have been about 24%. So Thor Equities was looking for like a, more than 50% reduction in the amount of the charge that they would have to pay off this loan. So order of magnitude, it's a $23 million loan. A quarter of that, almost $6 million, is what they would have had to pay. They were looking to pay more like $2.3 million for this. It hasn't been resolved yet. It's not clear at this point what the special servicer has decided, but the property has now been sold $40 million to a quote unquote high net worth individual from the Middle East. That's down from a $44 million valuation in 2017. So it will be interesting to see what the special servicer decides. Do they let Thor kind of skate on this extra yield maintenance charge and pay off the loan or not? In terms of more detail, 16,000 square feet of space, and the tenant is Alo Yoga. Now that I'm looking more at the details.
In Tripwire, we released the November payoff report. Manus, what were the details behind that?
It's interesting. The payoff report, for those that don't recall us talking about it a couple weeks ago, is that we look for loans that have reached their maturity date and try to get a sense of what percentage are paying off on time. So we take out loans that paid off early, either through defeasance or having prepaid at their first open. We take out loans that are already distressed, and we're looking for loans that just get to maturity. What percentage pay off? In that May, June, July time period, the number, which normally in historical, in normal times, it's 60, 70, 80%. That's the number we see. However, in May, June, and July, only about 10 or 15% of the loans that were reaching their maturity date were paying off. This month, that bounced up to 80%. And the reason for that was two big loans paid off that provide kind of green shoots for the market, in my opinion. The biggest loan to pay off this month on time was the $350 million Outlet Collection Jersey City loan, which was paid off in its November maturity date. The collateral, 1.3 million square feet of retail space in Elizabeth, New Jersey. The commercial mortgage alert reported back in October that they were looking for financing, and they seem to be close. The loan was split between two 2013 deals and one 2014 deal. Two of those deals are part of CMBX 7. So this is a case of really hard hit market, really hard hit sub-market, meaning the Northeast, really hard hit category, which is shopping malls, and the borrowers are able to get financing. So a really, really encouraging sign for both the CMBS market and the lenders there being able to get a deal over the finish line, and also the borrowers being able to get refinancing. The other loan in this category, the $200 million Starwood Capital extended stay portfolio loan, that was resolved with a very, very tiny loss, less than 1%, which is probably not a true loss per se at all. It's probably just a reflection of special servicing fees being taken out of the payoff of the loan. The note was slated to mature in July, backed by 50 hotels. The loan was given a short-term extension, split between one 2015 deal, two 2016 deals. The bigger loan piece was part of CMBX 9. So again, here, a situation where maybe people are looking at this loan saying, this is a dead loan walking, 25% loss coming, really long tail, no resolution, and all of a sudden it gets resolved away with really, really tiny loss. So two pieces of really good news out of that payoff report.
What you call green shoots.
I was going to say, Manus is always glass half full, and yet
that's new, though. I think that's changed. I think early on in the podcast, in the life of this podcast, I think Manus was the half empty guy, and now I feel like he's turned the corner.
Listen, lest you think he's completely changed, we're going to shift gears a little bit. Even after a vaccine is widely available, there is still concern that there will be permanent changes in consumer and corporate habits. impacting malls, hotels, and offices. And we saw a number of stories this week that bring that to light.
Well, we also talked to Michael Bull of Bull Realty, also of the Commercial Real Estate Show. We're following in his footsteps in the commercial real estate podcast game, and we talked a lot about whether or not this new work from home thing was going to be permanent, and whether or not there's going to be a recovery in offices. And he was very bullish on the office long term. But of course, you're going to see articles every week, about the changes in the way society works and the way people interact with each other, and the way the economy works. Nobody is smart enough to foretell that, right? It's only going to be in hindsight that we're going to be able to be like, oh no, duh. It's like, you should have invested in Zoom in March, no duh. But at the time, you weren't really thinking too hard about it. So I think we've talked about it a ton here on this podcast, but the acceleration of online shopping is just the acceleration of the trend that was already happening in retail. He also talked about government leased office and medical office. I was at the doctor's office today. There's a medical office park, and there was not a parking space to be had in the 300 car parking lot. So I'm thinking I got to buy that building. I wish I could own that building, but I don't know, Manus, you sound like you have something to say.
I think there's going to be a big regional effect. Michael is an Atlanta guy. Atlanta's been a big recipient of corporate transitions away from the Northeast, as has Dallas, Fort Worth region, and others. So I think his perspective is probably aided by that. I think he also lives in a state where shutdowns have been less onerous and less lengthy. So I think that, from his perspective, I think he's probably expecting Atlanta and the Southeast to come roaring back, a thesis that I kind of agree with. And I think, Dallas will continue to do very well. Austin, Salt Lake City, places with favorable tax environments where the square footage cost is, 1/4, 1/5 of what you have in Manhattan. Just this week we saw Goldman talk about moving its wealth management, I should say its asset management arm, outside of New York to either Florida or the Dallas area. And I think that will continue. I was talking to another gent today who has got a huge presence in the Times Square area. And he says they're not talking about coming back till July. So, I think there's winners and losers. The winners are those places that will continue to attract business. I think the losers, as I've said before, 24-hour cities. You don't go another day without seeing companies saying when they come back, it's going to be a hybrid 3 days on, 2 days off type work. And I think the people that are over 40 are going to demand that. They've realized that the 90-minute or 2-hour commute every day is not necessary, and they will work hard to make sure that they can continue this lifestyle into the future, and many firms will be accommodating.
Well, I think Martha mentioned the Real Deal. They had an article which was pointing to a Bloomberg article, which was pointing to a Morgan Stanley research piece, which was the upshot of that research piece was that Morgan Stanley was projecting losses on the CMBS market anywhere from 5 to 8% total, which is a high number, I think. Not that I'm saying it's higher than it should be, but that is, on the face of it, 5% doesn't sound like a lot, but 5 to 8% gets you up into the double B, sometimes the triple B level. And I guess I didn't see the report yet from Morgan Stanley. I have an email out to go to try to take a look at that. But if lodging and retail make up kind of 50% of the CMBS universe, and lodging and retail take 10 or 15% losses, it kind of makes sense.
Yeah, I think that those losses probably, in terms of loss severity, probably everybody would sign on to that right now.
Right.
If you were going to take 15% losses on your shopping mall collateral, I think that that's a done deal. So I think that those resolutions will be very, very painful for people. I think in the, going back to the 24-hour city, one reporter I spoke to recently, and I wish I could remember who said it because they put it really well, and I'd like to give them credit for it, is, New York City is an ecosystem, and people are attracted to the ecosystem, right? They're attracted to Broadway, great restaurants, nightclubs, live music, sporting events, young people, bars open till 4 o'clock in the morning, right? It's an ecosystem. And if we come back and only 60% of the workforce is coming back, and you have fewer restaurants, and it's not as fun to go to a concert because people are sitting further apart, or it's more expensive because the venues are small or you can't get in. I think that ecosystem starts to fray. And that's why I think that, New York could be a little bit perilous going forward, right? If that's the new normal.
Well, you remind me of the very first time I went out to a bar in Boston, and my friend who's from New Jersey and me who's from Yonkers, we were hanging out, going around campus, doing whatever. And then we got to the bar, and we get to the bar at like 11:30. We order one drink, and then all of a sudden it's closing time. It was last call. And we were so shook by that, because then I realized, like, wow, maybe it's actually just a very New York type thing that the bars are open till like 4 a.m.
Well, if you went to Second Avenue, which we would always do after work, being in Midtown, there's a stretch of Second Avenue between about 48th Street and 59th Street. Both sides are just loaded with bars. And
every Fordham alumni knows that stretch very well.
It was the kind of thing where it didn't really close at 4. You just had to be in by 4, right? And they would lower the curtains, and that was it, right? Nobody else comes in, and you sneak out, when the sun's coming up. Certainly not on a work night, but
of course not.
Of course not. But yeah, they would just lower the blinds. A lot of the people coming in right before 4 a.m. were people that were working in other bars and restaurants, right? That's when their night would start.
That relates to commercial real estate in some way, because those guys are tenants in these buildings. That's why we're talking about it, right?
As if we've never had a tangent.
If anybody ever spent any time at the Jolly Tinker in the Bronx in the early 2000s, send us an email at podcast@trepp.com and we'll commiserate.
We also had a number of Trepp stories, Manus, and one of them dove into some Charlotte office moves.
Yeah, this is it was a combination of something old, something new, something borrowed, and something to make us blue. Every month we're looking at lease turnover in our database. Joe cuts me the data, or one of his minions, and they show me, what are the big expiring leases in the next 12 months and how much square footage they have, and what does that represent of the overall square footage. So we checked in on the Charlotte market. What we were interested in was, back in 2019, we noted that Wells Fargo was looking to move to 300 South Brevard in that city, and it would be, vacating some of its space, perhaps a lot of its space at Wells Fargo Center on College Street. And we pointed out that lease is now only a year away, right? The expiration of that. That particular lease backs a loan, $175 million loan at 301 South College Street. Wells Fargo is the dominant tenant, 75% of the space in the 1 million square foot tower. Almost 700,000 square feet of that lease ends in late 2021. So that space is going to be coming to hit the market, perhaps at the worst possible time for the owners in that city, right? New space has come on the market. A new tenant has left, huge swath of space. And then, all of a sudden you have, as an owner of that, 700,000 square feet to backfill in less than 12 months. It comes on the heels of another story which broke last week, the Charlotte Business Journal reported this, that in addition to that, Lowe's is looking to sublet a lot of its space at the Charlotte Plaza. Lowe's is the top tenant at that 630,000 square foot property. They have about a third of the space on a lease that ends in 2024. The property is also on College Street. The firm is looking to put about 100,000 square feet on the market, which would only add more to the inventory. That particular property is part of a CRE CLO deal, which is worth watching. Actually, two CRE CLO deals that are worth watching as this story evolves. But as with so many other cities around the country, a lot of space being shed, a lot of new inventory has come on in the last few years, and a lot of developments that we'll have to watch over the next year.
And in the hotel space, we saw another collateral value reduction story.
The story, that you're referring to is the opposite of the Starwood story that we talked about before, when that big Starwood loan paid off with just a microscopic loss, taking out of circulation a big loan with collateral of 50 hotels across the U.S. The other side of the hotel story comes via the $204 million Schindler NSSP hospitality portfolio loan. We started writing about that back in July. At the time, the borrowers were looking to transition the properties to the mezz lender. December remittance data brought some new color. On the negative side, number one, the collateral, which was valued at $357 million at securitization, was lowered this month to $173 million. So the collateral now about $30 million underwater. The loan remained at 90 days delinquent with a last payment date as of March, according to the December remittance data. But in addition, recent remittance comments noted that discussions with the mezz lender have stalled. And that's a quote from the special servicer comments, which means that, the mezz lender is unlikely, or perhaps at least having second thoughts towards curing this loan and taking over the collateral. So not a great story there. The loan backs the single borrower HMH 2017 NSS deal. The collateral, 22 hotels across the U.S. About 2/3 of them are located in the Southeast, which, that's the part of the country you thought would have been a little bit more immune to some of the problems than maybe the Northeast and other areas. But certainly a story we're watching closely.
You took the words out of my mouth, man. As you were going through the story, I was looking at the properties and I see a couple in California, but then you see Georgia, North Carolina, Florida, Texas, Georgia, North Carolina, right? So you would have thought that those would have kind of fared a little bit better. Maybe these guys should just convert all of these to Airbnb houses, right? Just rebrand it and see maybe you could trick people into going then, right?
Yeah, it's as I said at the top of the podcast, I'm just waiting for this December remittance data to really start flooding in, because I do think it'll be an inflection point. I think we see a lot more loans going to grace period this month, and more guys struggle and kind of have this kind of story.
And our deal of the week, Manus.
We had a couple of them. The first one comes from kind of a regular. We've been referencing this person's stories a couple times over the last few months. Beata Lorenz of Commercial Property Executive really keeps it on top of new leases in the market. That reporter noted that Lionstone Capital padded its tenant roster over the last 30 days. They own Park 80 West in Saddlebrook, New Jersey. It's a 510,000 square foot suburban office built in 1972 and renovated 3 years ago. It backs a $75 million loan that is part of a 2018 CMBS deal, 85% occupancy as of June. And they've added 4 new leases totaling about 70,000 square feet, if I'm adding this up correctly. Van Houten Corporate Realty helped link a 25,000 square foot lease at that property. JLL did 2 leases for another 32,000 square feet. CBRE's Don Sperling and Robert Norton repped Lionstone. So that's an area where if you were worried about leases rolling off, or if you were worried at all about that 85% occupancy, both numbers should be better in terms of tenant retention and bumping up that already impressive occupancy number. So good news there. The other story came from Connect Media. Peloton is quintupling the amount of space that they have in Plano, Texas. They had a 27,000 square foot presence at Legacy Central in Plano. They're bumping that up to about 130,000 square feet. The property backs a $48.2 million loan, which is part of a 2018 CRE CLO. The property itself, only 24% occupied according to servicer data. As Joe has mentioned before, these CRE CLO loans are often transitional, short term. The borrower is looking to add, replenish a tenant roll. So this is a great step. This will up their occupancy by about 25%, which will go a long way to making it more full. Samsung is the largest tenant currently there. Baron Aldrine and Mike Connor of CBRE repped Peloton. Nathan Durham and Dwayne Henley of Transwestern repped Regent Property, which owns the building.
Yeah, Plano. I hear that name a lot. My wife is a recruiter and she's worked at two very large banks, and now she works at a large consumer products company, and everybody is hiring in Plano.
Plano's been on fire for years. It's just, one headquarters after another going down there. The neighborhood that has the new Dallas Cowboys headquarters, right? Irvine, Las Colinas, right? Just one after another. And I think that it continues.
It's easy to build and the taxes are low.
We had a number of inbounds, so that means we have a deluge of shout outs this week. And it starts with, I think it's because we offered up Trepp merchandise last week. So we had a number of people wanting shirts, hats, and whatever Keegan would be willing to send.
Bobbleheads.
Yeah,
What's the bid at for that dinner or lunch with Keegan? Did we put that on eBay for the Smith and Walensky lunch?
Coming in pretty high right now.
It's about 0.0002 Bitcoin so far.
It just reminds me, we put out this multifamily piece before we get to the shout outs. And we talked about last week, and some people came in asking for our spreadsheet. It talked about multifamily properties that had substantial reduction in occupancy over the last 6 or 7 months in the multifamily front. We talked about the Gary property a few weeks ago in New York, a Fort Worth property as well. And we made a spreadsheet that we made available to our listeners. We had a lot of requests for that. But Keegan pointed out that one of the properties that had seen substantial reduction in occupancy was 365 Bond, which is in the Gowanus neighborhood of Brooklyn, not far from where Keegan lives. And I was hoping that, when he pulls his binoculars out of his drawer, like he usually does most nights, and starts looking out his window, he could focus them on the Bond Street property and see if it looks like it's had substantial reduction in occupancy. Make
Maybe
sure
when
our
he's
data
walking
looks...
the dog,
All right. He's cracking up right now. Shout outs. Michael M. from New Jersey had some very interesting news from the ground. Properties that seem to be having problems. Eric H. can't thank enough for these conversation. Eric S. in Seattle, he was up for the road trip. Michael H., a broker licensed in several states, loves the show and sent us the Esquire article, which Manus was quoted in, and interesting quote. If you haven't looked at that article, it's a good one.
Thank God the editor had never listened to any of Manus's fashion tips on this podcast, or else he might not have made it into Esquire.
It's probably true.
I was hoping there would be like one of those guys knocking on the door. They could see my, multifaceted, giant sweatpants that are good for sleeping, lounge wear, and also going out to get my bacon, egg, and cheese on a roll in the morning. So they're incredibly versatile.
Todd O from San Antonio, Texas. He's been listening for decades, which is kind of funny. Patricia N, who wanted info on the falling occupancy story. Adam B from Rockville, Maryland. Chris L in Manhattan Beach says that one of his memories of 2020 will be listening to the pod during the summer while walking with his toddler around the neighborhood.
So I have to address that one because I read Chris's email at like 11 o'clock at night. I think he sent it late last week at some point, and I had to walk in. My wife was brushing her teeth, and I'm reading this, or I'm like, can you believe this? Like, this is such a nice email to get from somebody. And my wife's like, yeah, whatever, like, get out of here. Who cares?
Wow.
But to know that, you know, there's people out there kind of walking their dogs or hanging out with their kids or driving their kids to school or whatever it may be. And we happen to be able to give you a little bit of information or hopefully just a tiny bit of entertainment. You know, we're just sitting here looking at each other on a Zoom screen, and we're trying to do our best to kind of relay some good stuff out to the world, and to hear, you know, people giving us this type of positive feedback. It warms my heart. And I'm not too sentimental, but it does warm my heart.
It's great encouragement. Absolutely. Others would be Adrian in Michigan. Thank you for your comments. Lara in Ohio, Marty S, Matt K.
I got one more, which is Mike M from Somers via Riverdale. He keeps asking for Lonnie to come back. I think he likes Lonnie better than me.
Ouch.
We all like Lonnie, you know.
Better than me?
What's not to like?
A little bit. Yeah.
It seems that the pandemic is boosting the value of just about everything digital. So deals that are the stuff of rock and roll fantasy seem to be coming true. Bob Dylan made a deal worth an estimated $300 million for his entire music catalog shortly after Stevie Nicks announced her $100 million deal. So my question, Manus, is which legacy artist is at the top of your list for your TikTok video?
Well, I would say it would be the Talking Heads.
How did I get here?
What's that?
How did I get here?
This is not my house.
No, I just think it would probably be me paraphrasing the words from, you know, Life During Wartime. Everybody knows the song, right? It's, you know, in my version, there would be, you know, there ain't no party, there ain't no disco, there ain't no fooling around, there ain't no dancing or lovey-dovey. Nobody's got time for that now, right? That's kind of the 2020 song. But to Martha's point, two things. One is that, you know, when we talk about frothy valuations, when people are starting to buy for music rights in a time where music rights just seem to get cheaper and cheaper and cheaper for what Spotify pays for or others, tells me, as with DoorDash and Airbnb, that we are near a market top, number one. And number two, for Bob Dylan to only get 300 million and for Stevie Nicks to get 100 million, you know, if I'm Bob Dylan, I'm asking my broker, dude, what on earth is going on here? Stevie Nicks has got like 8 songs.
That was only for part of her catalog of music. It was his entire catalog of music.
But she's got like 8 songs, you know, with all due respect, although she did show up for one of those Nomura parties back in the day to entertain the crowd. So,
well, I read that they have it's like a cap rate, except it's for music streaming rights, and that usually libraries would go for 5 or 6 times your estimated annual streaming revenue on the library, and that Dylan went for something like 12 or 13 times. So that's probably due to the fact that it's Bob Dylan, but also due to the fact that there are very few places to get any sort of cash flowing yields. I wonder if Taylor Swift, I'm still trying to figure out what Taylor Swift's doing, trying to get back the rights to her music. But yeah. If I was a long-term investor, I might be trying to buy her library.
Just remember, there is no Mud Club or CBGB anymore. We ain't got time for that now.
With that, we'll close. Thanks to our producer, Keegan St. Ange. May join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question, want a t-shirt, send us a comment. Send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.